Right, a very good afternoon, ladies and gentlemen joining us this afternoon. Welcome to the East Africa Law Society special webinar series. And today we are privileged to be discussing yet another very pertinent subject on capital markets. And this afternoon we'll be looking at capital markets in 2025, and we are asking ourselves where opportunities for lawyers are, how we can tap into this enormous potential that the capital markets do offer us. So this afternoon, we have a very well-established panel from across Eastern Africa. They work from areas of being on capital markets authorities in different partner states. We have seasoned legal practitioners, and then we have those who are quite enthusiastic about capital markets. And like you all know, capital markets have now experienced a transformative phase, and even the economic growth and technological advancements within the East Africa community, there's been spontaneous growth in this, and lawyers play a very critical role in navigating the complex regulatory frameworks in capital markets. So this afternoon, we'll be exploring quite a number of topics that stem from highlighting emerging trends to identifying legal opportunities, and how do we foster regional collaboration and empower diverse opportunities. And to take us through this session is a man whom I greatly revere, my very good friend, Mr. Eli Obegi, one of the seasoned advocates that we have across the region, but also an enthusiast of capital markets generally. Eli is joining us from Nairobi, and he is a senior advocate at ENS Kenya and a member of our ELS committees. So Eli, we are profoundly honored to have you this afternoon. Thank you so much for accepting to moderate this session, and I'll hand it over to you now to take us through the next phase of our webinar with the introduction of speakers and facilitation of the discussion. So over to you, Eli. Thank you.
Thank you very much, Gabriel. I can see we have a number of attendees admitted, and I believe we can kick off. Good afternoon, everybody, and welcome to this auspicious webinar organized by our good friends at the East Africa Law Society Capital Markets and Securities Law Committee, led by my senior Patricia Mutiso, the chairperson, who is with us this afternoon, and our colleagues at the East African Law Society Secretariat, including Gabriel, who I thank very much for the warm introduction. We are in for quite an exciting discussion this afternoon on the state of capital markets law and regulation in the region. We are going to receive some key insights from panelists from all across the region, and we expect to hear from them on their expertise in the area, on what is going on in capital markets region-wide, as well as key insights on how us as East African lawyers can best equip and position ourselves to seize opportunities in this sector. Just by way of brief introduction, I will start with Patricia Mutiso, who, as I mentioned, is the chairperson of the East African Law Society Capital Markets and Securities Law Committee. an advocate of the High Court of Kenya, and an international trade law and policy expert. Patricia, perhaps you could just say hello to everybody.
Thank you, Eli Obengi. Yes, my name is Patricia Mutiso. I am an international trade law expert, and I've been in the capital market space for about 10 to 12 years. Thank you for joining.
Thank you, Patricia. Patricia will kick us off with the presentation after I finish the round of quick introductions. Next up, we have with us Alison Ikiriza Serukaka, who is a manager for legal and board affairs at the Capital Markets Authority in Uganda, and an advocate as well of the High Court of Uganda. Alison, I would appreciate it if you could say hello to everybody and give us a few words before we proceed to the introductions.
Thank you, Ellie. I hope I'm audible.
Yes, we can hear you very well. Thank you.
All right. Thank you for the confirmation. My name is Alison Kuchiriza Serichacha, as introduced. I've been in the capital market space for about 10 years, primarily working in the market with players in the market, but also as legal and compliance with the stock exchange, and currently with the principal regulator, the Capital Markets Authority of Uganda. And I'm happy to be invited to discuss very exciting topics at this forum. Thank you.
Thank you very much, Alison. It's a pleasure to have you here with us. Next up, we have Adela Kale, who is an experienced lawyer with the Capital Markets and Security Authority in Tanzania. Welcome, Adela. Would appreciate a couple of words by way of introduction.
Hello, everyone. As introduced, my name is Adela Kale, working for Capital Markets and Securities Authority Tanzania. I'm currently heading the legal department, and I've been working with the regulator of capital markets for 10, 11 years. So I'm happy to be here. Thank you.
Thank you very much, Adela. Next, it's my pleasure to introduce Doris Otiato, a governance, compliance, and regulatory counsel, and an advocate of the High Court of Kenya, as well as a certified public secretary in Kenya. Doris, I would appreciate a few words here with us.
Hey, Doris is joining shortly, so let's proceed while she joins.
No problem. Thank you, Gabriel. And last but not least, we have with us Charles Mabiru, advocate. He's a securities and investments lawyer based in Kenya and founding partner of M&A Advocates in Nairobi, as well as an experienced capital markets trader. Charles, the floor is yours.
Pleasure to be here. This will definitely be something interesting for everyone, and I can't wait.
Thank you very much, Charles.
Right. Doris has joined us now.
Doris, it's a pleasure to have you with us. Could you kindly say hello to our colleagues who have joined us by way of introduction?
Thank you, Eli. Thank you, Gabriel. Colleagues, good afternoon. My name is Doris Sotiato, Governance and Compliance Counsel. Happy to be with you here. Thank you.
Thank you very much, Doris. I think that's it for just a brief introduction of our panelists. Just to save us some time, we'd like to jump right into the webinar presentations we have this afternoon. Each of our panelists will take about 15 minutes to give us their respective presentations on the current state of capital markets law, and as well as their experiences and insights in this area of law in the region. We will take a Q&A session at the end, hoping that we do well for time to allow all of our questions to be put to the panelists and addressed. I understand that Patricia will go first with her presentation. As introduced earlier on, Patricia is an international trade law and policy expert and the chair of the East Africa Law Society Capital Markets Committee. She is a seasoned lawyer with over 15 years experience in capital markets and international trade law, and she is an advocate of the High Court of Kenya as well. I will relinquish the floor to her to take us through her presentation. Thank you, everybody, and we are very happy that you're with us this afternoon.
Thank you. Thank you, Ellie. So my presentation is going to be about navigating regulatory reforms, legal roles in market access, and it's mostly going to be on due diligence compliance and issuers and underwriters. Yeah. So the first thing is what are regulations? Because some of us might not understand what regulations are. So regulations are basically rules or orders that are prescribed by the authority. And in this particular instance, it's going to be the Capital Markets Authority in Kenya, because I practice in Kenya. Something else somebody would ask is, what is market access? Market access is the ability of a business to be able to enter and exit a market at any given time. So the question is, so what is the evolving role of lawyers or legal advisors in compliance? Traditionally, the legal of compliance officers was pretty easy. I remember when I was working in an Islamic bank, our role was just to go through the regulations of the Capital Markets Authority, like the collective investment schemes, and ensure that we complied to them. But the role has now changed, and it's no longer that. Now, lawyers have to be able to anticipate the legal risks when they're looking at the compliance, and it's not just what is in the book. You have to think outside the box. So that is where the role is. You anticipate the legal risks, and you're able to advise on any measures that can be foreseen. In the past, compliance and risk management were seen to be two different divisions. When I was in the bank, we had the compliance division and we had the risk management. And most times you'd find that the risk management division was not the most popular division, because we say that it curtailed movement and the growth of the banks. But right now you find that compliance and risk management are intertwined. Compliance and risk management got together, because the way things are going now is anytime you go into a business, the compliance and risk management divisions have to work together so that they can be seen to be evolving the business. The other thing is, when it comes to compliance, right now, you have to ensure that the strategic business partners must ensure that they work together, that it's not different, yeah? Because of the ethics of the business, people want, and businesses want you to be involved and want to be together. Now, when clients come in, they just don't want to tell you, they don't want you to tell them that what you provide is regulatory compliance. They want you to go over and above that so that you can be able to deliver adequately on the business. So how has this shift changed from many years to now? What is the ask right now? The ask right now is to be able to make compliance very fast. When you're going through the compliance, it has to be very fast. So what do we need? We need technological advancements. And that's why everybody right now is talking about artificial intelligence and data privacy, because legal advisors must be informed of the new technologies, and AI is making it easy to be able to. It's not like 10 years or 12 years back when we joined, and it was difficult because everything had to be manual. You had to use a manual document, a physical document, and highlight it. Yeah. So right now things have really, really changed. Hence the importance of digital transformation. Yeah. Where you find that tech has helped to improve efficiency, it has helped to manage workflows, and it's also enhancing compliance efforts, making it very, very easy now to be a compliance officer. But having said that, even if the AI is making things easy, you must also be cognizant and you must also read and know what you're doing. Yeah. Don't expect the AI to deliver for you the full results. The human effect is still necessary when it comes to regulatory compliance. Yeah. So what are the evolving responsibilities right now in 2025, which were not in the business when we joined like 10 years back? Yeah. Now we are seeing the entrance of data privacy. Yeah. Data privacy, people are more aware, people are more sensitive when it comes to their data. So as a compliance officer right now, you have to be conversant with the necessary laws on data privacy. You have to ensure that as a compliance officer that you comply to this. You also have to ensure that you implement the data security measures in the system, whether you're working in a bank, whether you're working in an insurance company, or even when you're working in a law firm because you have data there. You also have to ensure that in case of any data breach, you're able to manage it in real time. How do you do this? Of course, when it comes to the manual way, it's going to take long to be able to amend that. So you have to come up with good and effective ways to be able to manage your data breaches. So AI regulation has also become very important when it comes to compliance. I know many people don't agree. They see that AI is coming to take over their businesses, but that is not the accurate position. Actually, AI is here to make your work easier. As initially mentioned, when I joined the banking world many years ago, we had volumes and volumes of paperwork. But right now, it's easy because everything is digitalized and it makes things easy. It makes work easier to work with. As compliance officers right now, you also have to deal with the ESG compliance, the environmental, social, and regulatory compliance. It's very important right now as a compliance officer or as a lawyer who's a compliance officer to be able to deliver on this, because sustainability is the in thing if you want to hear. Yeah, it's no longer way back when we used to say, oh, ESG is peripheral, it's not needed for a business. Right now everybody is asking, the ask right now is ESG, because it means that your business is sustainable. The stakeholders, the board, everybody will be asking you to be knowledgeable on ESG. So you cannot just it's not just ESG alone, yeah? ESG is now an imperative part of working with compliance and also working with the risk management, yeah? So what are we also saying? We are also saying that fintech has also affected your job as a compliance officer or as a legal person who's working in compliance, because you must also, that now brings in the aspect of anti-money laundering. You have to be aware of what is going on with the anti-money laundering and also your KYC procedures. What is KYC? KYC is know your customer. You need to be able to know your customers so that you can efficiently deliver on your role as a compliance officer. Cybersecurity is also an important tool when it comes to compliance, because the threat of the internet, the threat of AI is real. So you also must be aware with what is going on with the cybersecurity aspect of it. Something else that I was asked to speak about is due diligence. What is the evolving role of lawyers when it comes to doing due diligence? Due diligence is something that initially was very hectic. You would sit in the office and work for hours and hours on end. But in modern times or in now, it's becoming very, very easy, yeah? But it still remains very crucial in businesses, because when we have foreigners entering the market or people buying businesses or other businesses being acquired, you still need to do your due diligence. Yeah. So Due diligence for lawyers is very important, especially lawyers who work in the commercial space and also lawyers who are in the trade space also. It's very important for you to be able to do your due diligence effectively. Yeah. So due diligence right now is not what used to be done 10 years ago, where you're just identifying the risks. It's no longer that. It's the same thing as compliance. You have to be proactive. You cannot just look at the risks. You have to be able to understand the overall strategy of the company that is asking you to do the due diligence. What is the company? What is it about? So the legal counsel has to be part of that. You have to be part of the discussion about the due diligence from the onset. It can no longer be way back 10 years ago when we used to be given a pile of documents and told to produce a due diligence report. It's no longer that. From the very beginning, when the client comes into the law firm or it comes into the business and requests for due diligence, it's very important for the counsel to be able to be part of that discussion so that they can understand the overall strategy. When you understand the overall strategy, then you're also able to anticipate what the legal challenges are. So that when you're looking through the documents, or if you're using AI to go through the documents, then you as a person are aware that I was in this discussion from the onset and these are the legal challenges. You're also, as a legal counsel, expected to contribute towards the strategy. You're also expected to contribute towards the structuring of the deal. Yeah, because if you're doing the due diligence, it's no longer you in a corner office just sitting there doing a due diligence and submitting the document. No, you also need to be part of the structuring of the deal. You need to be able to understand how it's going to be structured so that you can give your input when it comes to the strategy. Yeah. So that's very important when it comes to due diligence. So due diligence in modern time, right now, the scope is bigger than it was a while back. Because again, you have the ESG factors, which are also part of it. And this involves also looking at different regulators. Sometimes when you're doing a due diligence, you're also dealing with experts who are not just lawyers, experts who are economists, experts who are auditors, experts who are different to be able to understand the different risks. Yeah. So again, when it comes to what is a place of lawyers in modern time, and when it comes to doing due diligence, it calls for you to be a team worker, because you're going to be working with experts who sometimes don't understand the law, but they are experts in looking at the documents and analyzing them in other ways. So that brings in the integration of the other disciplines. So your role as a lawyer in due diligence is to be open-minded, it is to be agile, it is to be able to understand and take in the views of the other people. And that is where you realize that there's no monopoly of knowledge, because these other people are giving you different ideas, which you have to incorporate now when you're drafting your due diligence report, or even in the instance that there's an initial public offering and you're part of that, you're able to advise and guide accordingly. So again, like we mentioned, we come back to artificial intelligence, we come back to technology and fintech, which makes the work easier. But then the human element remains key, because it is you to be in the discussion from the beginning. It is you to drive the strategy. It is you to give your input. Yeah. So AI is good because it's going to bring in an analysis, a data analysis of the cumbersome documents that 10 or 15 years ago you had to go through, spend the whole night and day looking through heaps and heaps of documents. But now AI makes it easy, because it can be able to go through the volumes of data and identify any patterns or anomalies in the documents that you're doing your due diligence on. And this helps you as a legal advisor to work faster and to be able to identify the real issues that you see see in the data. So that's really the role of lawyers when it comes to what is their place when it comes to doing due diligences right now. So they need to do a thorough legal review of the legal documents, be able to advise them, give a compliance assessment of the documents, advise on the risks, mitigation, and also report in writing what is there. And the future of lawyers when it comes to DD is to be able, you have to be agile, you have to accept technology, you have to accept AI, and you must be able to work with it, yeah, so that you can be able to deliver on your role as a lawyer who's doing due diligence, who's in commercial law, or who's even in trade. Even in international trade, we sometimes do due diligence. So you have to be an all-rounder and understand what your role is as a lawyer who is doing a due diligence. I think the last aspect that I was asked to comment was on issuers and underwriters. What is the evolving role of legal advisors when it comes to drafting for issuers and underwriters? So an issuer is a company that is, what can we say, is going through an IPO. It's going from private to public. Underwriters are people who draft the documents, the prospectus that are sent out there. And you realize that none of these people will be able to work alone. As a legal advisor, you must work with the issuer. You also must work with the underwriter, because the underwriter is the person who's going to prepare the whole document, which is going to be sent out to the people who are going to invest into the company. So back at it again, you have to be in the room. You have to be in the discussions from the onset when the IPO is being drafted, when the communications are being done. And when I looked at this question, when it was sent to me by ELS, in terms of discuss the evolving role of legal advisors when it comes to the drafting for issuers and underwriters, I think what came to my mind initially was, do lawyers or legal advisors matter when it comes to IPOs, the outcome? And my answer to that was yes, they matter, because when it comes to IPOs, there's a lot of litigation risk. One of the biggest issues when it comes to IPOs is a litigation risk, because you find that different law firms have different skills, and they have different abilities when it comes to preparing for IPOs. And that is why most issuers will go for maybe the big tier firms because they have more experience, or you find that they will go for lawyers who are working in investment banks because they already have the skill. So the future of lawyers when it comes to IPOs and drafting or issuers and underwriters is to be in that space. And how do you join that space? You can start working in investment banks. You can start working in fund managers. You also have to sit for your exams. I remember when I was in an investment bank, which was an Islamic bank, at the time we had to do Islamic capital markets exams. But right now, Kenya has evolved. So you can sit for the CSI exams so that you can be in tune. You can also sit for your chartered financial exams so that you can be able to understand the marks and everything, the investments that is going on. That is if you want to go a notch higher. So the future of lawyers when it comes to drafting for issuers and underwriters is, first, you need to have the knowledge. How do you have the knowledge? You're already a lawyer. So you step up, you do your CSIs, you do your CFI, you work in an organization that is a fund manager, that is an investment bank, or maybe a company that is private and wants to go public. So you're able to utilize that information. And also you need to have drafting skills. Legal drafting is now offered in various and different places. So you can be a good drafter if you want to be a drafter, but being a legal drafter does not end there. You need to be able to understand what you're drafting. Hence the importance of you doing the courses which are relevant in investment banking so that you can be a good issuer and that you can be an efficient and nice person. So you can't draft one. So I think to end this for me is what is the future of lawyers in 2025 when it comes to compliance, when it comes to due diligence, and when it comes to being in the issuer or in the investment banking world. I think my comment is lawyers must really seize the opportunity because these are transformative moments even for us. We have to be able to embrace AI. We have to continue learning because the future really is going to belong to those who are confident, who agree to be innovative, and who are committed to enhancing their skills. And I think having said that, I think I am done with my presentation, and thank you so much for listening. I'll be able to answer questions at the end. Thank you.
Thank you very much, Patricia, for your very insightful presentation. As Patricia has mentioned, if you have any questions or any reactions arising from our presentation, please hang on at the end. We'll have a Q&A session. In the meantime, you can also drop any pressing Q&As using the Q&A function of the Zoom platform. Next, it's my pleasure to invite Adela Kale to briefly give us her presentation. As we introduced Adela earlier on, she is an advocate of the High Court of Tanzania, and she heads the legal team at the Capital Markets and Securities Authority in Tanzania. She is an experienced capital markets and securities lawyer with over 10 years experience in the sector. We look forward to your insights, Adela. The floor is yours.
Thank you so much, Ellie. I think I'm audible enough.
Yes.
Okay, thank you so much. It's a privilege once again to join this forum. Thank you, East African Law Society, for having me. I think I'm supposed to talk about on capital markets development in Tanzania so far and opportunities for lawyers to tap into that. As we have seen in several news and information that has been circulating, Tanzania capital markets have experienced steady development over the past years, with notable progress in regulatory reforms and product diversification. There's been a rise of thematic products. I believe Patricia raised some of the Sharia compliance products, the Islamic banking. Back on capital markets, we have the Sukuk bonds, and also we have the Sharia compliant collective investment schemes. They've also been issued in Tanzania under the Capital Markets and Securities Act. Also, we have a rise of collective investment schemes at the moment. The interest is very high, which is also part of the financial inclusion, and it's basically it's due to the awareness programs and public education that has been going on in the country. But interesting enough, the government itself has shown interest to raise funds via capital markets. And now we are working on with national entities. We're talking about government entities, the corporations. We've had one a year back with water supply entity. It's called Tanga Wasa. It's in Tanga for infrastructure bonds. It was a hybrid bond. It had a ESG elements, green elements. It also had an infrastructure part of it, and it was a revenue regenerated bond. Also, we have seen growth in so many innovative products. Crowdfunding. We've seen interest in crowdfunding. We're currently working on our sandbox. We are still in the process of preparing the regulatory framework together with the regulations. We're also looking up to engage the private equity and venture capital segment into the market. So we're in the final stages of drafting the regulations. So we hope with all that, the capital market space is going to be in another level in the next coming years. So having said that, maybe I just jump into what I'm supposed to present on the opportunities of lawyers in the capital market space. This can be in Tanzania, it can be in Kenya, it can be in Uganda, because we all work together under what we call AASTRA. It's an association which is under the EAC, and I see my colleague Alison is here. We also sit in the same committee on capital markets under that. So what I'm about to present on opportunities can be used in Tanzania, can be used all across the region. So maybe I can start with the transaction issue of transaction advisor and deal structuring. We have seen a lot of transactions that have been structured by various financial institutions, the investment advisor, the lead advisors. But as part of the requirement, like in Tanzania, our act, our law requires that whatever that you're structuring is in a product, if being a debt or an equity product or a collective investment scheme, there must be a part where a lawyer has to put an opinion on that transaction, on the issuer or the proceeds that are going to be raised. So that is it's an opportunity for lawyers to engage with these lead advisors or the banks, mostly who are structuring these transactions, to be part of that process. Also, we have issues of CIS, collective investment schemes. My apologies, I'm using the abbreviations, the collective investment scheme space. On collective investment schemes, basically, we have parties. You have a manager who is managing the scheme, the fund. Then you have the trustee and the custodian. So as part of this document to be submitted in structuring that scheme, there's a need of also having a trust deed. So it's another opportunity for lawyers to tap in and see that they get such opportunities to draft these trustees, contract management, their contracts that are entered between the custodian and the manager, and such areas which can be beneficial to the lawyers. Another issue is on the mergers and acquisition. We've seen a great rise of mergers acquisition that are affecting the public listed company, the PLC, even the public companies which are not even listed. We also see to that. So lawyers can also see on how they can use that space to learn first about the industry and later be part of the transaction on mergers and acquisition. Also, we have issues of these innovative issues. Currently, we are trying to go digital. As they say, the world is going digital. So we also have to get accustomed to that. So there are several applications that have been tabled to the regulator on issue of integrating between the intermediary, the market intermediary, the broker, the investment advisor, together with the exchange and MNOs. So all that needs a lawyer's attention in terms of contracts, in terms of compliance, because you can just look at the parties in that transaction. You see that the MNO does not report to capital markets, but another regulator. Then sometimes some of them do report their banks involved, report to BOT. So the need of compliance between the cycle, the cycle of all those who are about to integrate, so that they can, like, ease of doing business in the industry. Also, there's the issue of ESG. I won't talk much about it. Patricia have spoken a lot about it. ESG is something that we cannot avoid it anymore. It's a rising thing. And we have several products we've issued under ESG, about six bonds at the moment, which are ESG bonds. And currently, not so many lawyers have been involved in that space. So it's another area to look out to, and also engage, as I said before, with the transaction advisors. So unfortunately, with Tanzania, the transaction advisors are basically the investment advisor, the financial advisors. It can be the bank, it can be an investment company, it can be a broker, it can be investment advisor. So there's no any firm of lawyers that has been licensed as a transaction advisor. But it's not that it's not allowed. It's still, there's still an opportunity. If lawyers want to engage into that, they can engage into that. But in terms of ESG, there's an opportunity. There's rise of so many products under ESG. We had a Jasiri bond, which is matured already. It was a basically on women and women impact bond. We had a Kijani bond, we had Jamii, we had Samia bond, and the Tangawasa that I've mentioned earlier. Okay, another opportunity that I can say lawyers can tap in this capital market ecosystem, I would say issues of compliance and enforcement, because they are redressing mechanisms that have been set. Unless in case someone has not been compliant or someone has an issue or is an aggrieved on a certain matter in the capital markets industry, lawyers can still assist or take a position in advising and also representing these parties in the tribunal or before the authority. Another issue maybe I can talk about as we transform, as we evolve in the market, means that even the regulatory framework also evolves. So there have been several drafting that have been done by the authority. The doors are open for lawyers to be part of it, to contribute, to advise, to even give comments or contribute in any way that they think fit in those reforms. And as part of contributing, they'll also be able to learn more about what's going on in the industry, because the industry itself is revolving. Not what you've learned yesterday, it will be the same today. So there's that opportunity also. And now, currently in Tanzania, we are, as I said before, we are drafting regulation on private equity and venture capital to address SMEs and startup financing. That is another area which is new in the industry for us, and I believe to some of my counterparts in East Africa. So it's an area also lawyers can learn more about it and be part of that transformation, because these are private placement. Basically, they're not public they're not public issuance. So it's good that as we start this journey, they take that opportunity and be part of the journey, so as to enable to even evolve with the market itself. Those basically are I can say are the main areas that they can tap in. Generally, the whole market needs law practitioners to be part of it. But what I can say, despite all this, the opportunity that we have, I would recommend that the legal practitioners build more deeper technical expertise in capital market law and regulations. These are not the normal corporate law that we learn in school. They are not the normal commercial law. They're a little bit technical, and this is why most of the time we end up seeing that the financial experts are the only ones that fit enough for capital markets. But I believe even as lawyers, we have an opportunity. I heard Patricia say something about CICI. For those who don't know, it's Chartered Institute of Security and Investment. It's a certification course. It's recognized across the region. It's issued by each country in the region. And but it's a collaboration with the Chartered Institute of Securities UK. So after getting that certification, you can operate as an intermediary or as a financial advisor across the region. So I'll urge lawyers to think about it and considering going through such courses. I know Patricia mentioned some other courses where they can also be taken into board. Also, there's a need of us collaborating with financial experts. I've seen at several times you get queries, you get inquiries, not queries, actually inquiries from lawyers, from firms. They come to the authority, inquiries on a certain matter. But when you ask a lawyer, like, give me more qualification, obviously I understand it's not easy, but sometimes it helps a lot to advise on a way forward, what you can assist. Maybe you go see this person or that person, because most of the lawyers, they take note to understand that most of the submissions or transactions that to be submitted to the authority have to come through the licensed advisors, the licensed experts by the authority. So in that being said, when a lawyer gets such deals, such inquiry from the clients, I would recommend that they work very close with the financial experts and the capital market space so as to enable to advise the clients well, as well as being part of the transaction deal also. And also encourage more reforms that promotes finance and investor confidence in the industry. That is what I've been talking about, and also embracing digital tools and innovation. I know Patricia said a lot about AI. I won't say much about it, but we need to embrace on digital tools. We need to embrace on innovation for shaping this financial landscape. Maybe in just closing, I would say that the capital markets are just not I don't preserve for economists or financials. As lawyers, we're uniquely positioned to catalyze the safeguard of the growth of the market through regulation, structure, and justice. And for what the theme of this year, the opportunity of capital markets 2025, what I would say, the opportunities are just so much out there. There's a lot going on in this space. There's a lot going on being structured by the authorities in terms of the jurisdictional wise, in terms of the regional wise. We work with EASRA, we work with CISNA. CISNA is for the SADC Capital Market Subcommittee. A lot is in the pipeline. What we all need to do is just to go out there, learn. That's the only thing that I would say. I would just close up by saying we need to learn. The capital market industry is an evolving industry. It's a very technical industry. So we all need to go out there, learn, and engage with other people, and also do certification course so that you can even get confidence of whoever you are advising or structuring or running the contract management. Thank you, Ellie.
Thank you very much, Adela. We appreciate the time you have taken and the insightful presentation you have given us. Colleagues, Adela will be leaving us shortly. She has another engagement. So if you have a very pressing question specifically for her, we can give you 2 minutes to ask it. But nonetheless, we'll have a Q&A session at the end, and any of the other panelists will be able to address any questions you may have. I can see that there's nothing pressing in the Q&A and in the chat, but feel free to keep asking your questions using the Q&A options, and the panelists will continue to answer them as we proceed. Next up, it's my pleasure to introduce Alison Kuchiriza to give us the next presentation. Alison is a governance professional and an experienced in-house counsel in securities law and regulations. She's an advocate in Uganda and a member of the Institute of Certified Public Accountants Uganda. She is a legal manager at the Uganda Capital Markets Authority, where she is primarily in charge of the CMA's regulatory framework. She also has extensive previous experience as a private practitioner and an in-house counsel in top-tier financial institutions, as well as previously the Uganda Securities Exchange. Alison, welcome. We look forward to your presentation. Alison, are you with us? It appears Alison may be facing some technical challenges. In the circumstances, Doris, I would kindly request if you can go first, and then Addison will be able to join us.
Thank you, Ellie. Yes, I'm ready. I can join. I can.
Thank you, Doris. Just to introduce Doris again, Doris Otiato is a Governance, Compliance and Regulatory Counsel. She's an advocate in Kenya and a certified public secretary, as well as a GRI certified sustainability professional. She has extensive corporate experience in Kenya and in the region. Doris, you can have the floor and let us have your presentation.
Thank you. Allow me to share my presentation. Let me know if you can see.
You can see it, thank you.
Okay. So good afternoon, colleagues. My name is Doris Sotiato, as has been introduced, and I was asked to speak to sustainable finance with the legal strategies for green bonds and ESG. So just a quick one for understanding on what is sustainable finance, because this is not an area that we deal with every day. So sustainable finance, if I may put it simply, devoid of what I've put here, is channeling of funds or loans to green projects. So those projects that will have an impact to the environment, the society, as well as the governance, those are the ones that will get prominence because they are deemed to have impact on the society through which an entity operates. And as the World Bank has put it there, you'll note that bonds could be given. One of the things that can be given is green bonds and sustainability-linked loans to just ensure that there's a long-term, there's a long-term effect, positive effect in what entities are doing. According to the European Commission, this is by embedding the ESG consideration in every investment, it ensures that funds are directed to initiatives that generate lasting environmental and social values. Now, why does it matter? It matters because with sustainable financing, we are now seeing the transformation in the financial systems. It's no longer about what is in it for me in terms of interest. It is on what impact does my money have in whatever I choose to invest in. And you've seen with that many investors who are conscious of where the money is going to will wish to invest in green projects because with that, then they're able to see the impact of their investment in such projects, and they're able to see the benefits, which is measurable on the environment and social benefits on where they invest their monies. It also ensures that financial performance goes hand in hand with positive ESG outcomes. And as a result of that, there's always a feel-good effect that someone did something positive in their society. So as you get into the space of sustainable finance, there's some of the key terms or keywords that you cannot avoid, and some of them are the key components of sustainable finance. Starting with impact investing, this is where, simply put, I get a little financial return, but out of it, I'm giving you enormous social and environmental benefits. This could be in the areas of the healthcare, education, and renewable energy sectors. An example of what I can say would a little bit be on the part of impact investment. For those who may be in Kenya and a few other markets in East Africa, you will have seen Equity Afya. The model is you pay little, but the important thing is it's not about making the money. It is about ensuring that healthcare services are available and accessible to everyone. Now on green financing, this one is where there's an appetite for financing on environmental projects. So on matters of waste recycling, renewable energy, water conservation, prevention of pollution, you'll find some people will choose to do the green financing where they're just focused only on matters that have environmental benefits. And as a result of that, because environment and social will always go hand in hand, they find they're intricately related in such a way that if we manage waste, or if we have renewable energy, then it all translates to a household on how we live and improves our quality of life. Social responsibility. This one is focused on the people and ensuring that there's financing to projects that have social impact. I use social impact. This could be fair labor practices, pay for the pay improvement, access to clean water, and such like things. Then there's the ESG integration, whereby we weave ESG consideration into traditional financial analysis to ensure that where we're dealing with, if you're giving you money to do something, it's not going to be for the purposes of destroying that which is already there. Now here I just provided a snapshot of some of the sustainable finance tools. Please note that the list is not exhaustive. As we continue to develop this space, other tools are coming up, or other areas of interest are coming up that you find in corporations and investors are interested to see how they pan out. For the purposes of this webinar, I was asked to speak about green bonds. So I'll spend a little bit of time on this. So green bonds, as you'll note, for those who've encountered this, are some of the most prominent green finance instruments that we've seen, or we can say they've reached at that level where they are gaining maturity. Now, these green bonds, what are they? They are designed to raise capital only for projects that have environmental benefits. Now, as a result of that, the proceeds that come out of this project will be assigned or reassigned to other projects that have environmental benefits. Now, with the much that has gone into this space of green bonds development, we have the green bond principles, which I refer in here as GBP. So the green bond principles guide on how the green bond projects are to be managed and dealt with to ensure that there's a standardized way of dealing with. These green bonds are not a new thing. The first one was issued in 2007, which was done by the European Investment Bank. And after that, we've seen more and more come in, as you will see herein. So some of the types of green bonds, I've just mentioned like 4. So we have the standard green use of green, standard green use of bonds, of proceed bonds, whereby we have an unsecured debt obligation with the full recourse to the issue of that bond, and it is aligned fully to the green bond principles. Then we have the green project bonds, where the bonds are aligned to the green bond principles, where the investor has the direct exposure to risk. They take up that risk, and in the event that things do not go as planned, then the recourse will go to the issuer of that bond. Then we have the green revenue bond, where the issuer issues this bond, but then the credit exposure to the issuer, while it is aligned to the GBP, it is only limited to that amount that the issuer committed to deliver to the investors that pulled money into that fund. Then you have the secured green bonds. This is where the net proceeds out of these bonds are exclusively used for bonds only green, and those which had been planned for, and planned for by the issuer. So we have 4 green bond policy principles. So the green bond principles were issued in 2021 by the International Capital Markets Association. where it issued the green bond principles and the social bond principles. Now, there are 4 of them, as you'll see, and these are voluntary process guidelines that issuers are encouraged to apply or to adopt when they're issuing green bonds. And why are they important? Because they give a standardized way of gauging by investors the impact of the investment, how the issuers are reporting, and also the transparency levels that are required, as well as management of projects moving forward. So to start us off is the use of proceeds. The use of proceeds, simply put, is where bonds are, projects and assets from these bonds are normally selected. So initially, you'll find an entity will always have the type of green projects that it wants to invest in. It could be renewable energy, rates, the blue economy, and such like things. Now, the criteria for selection of these green projects is done in a clear and transparent manner. Disclosures of the proceeds are also done, and it's always made clear on how the proceeds will be distributed and to which projects. So the issuers will identify the categories of the green projects. Then out of these projects, they identify the assets which fall for eligibility for inclusion in the bonds. Why is this important? So the qualifying green projects, as you'll see here, it could be renewable energy, smart agriculture, efficient manufacturing, tourism, and such like things. Now, why is this important? As we've mentioned, it gives a baseline from which now issuers across the world, for those who choose to adopt them, are able to be guided on what they do, such that if I'm issuing a bond here, it doesn't change fundamentally on how it shows up when I issue it, let's say in the US. Principle 2 is the process for project evaluation and selection. This is an internal process which the issuer sets up for the selection of projects and assets. It is always important that there's a selection committee in place. And of course, that selection committee should be made up of, should be comprised of people who have the technical expertise or who have the knowledge on what exactly the issuer wants to achieve, the strategy of the issuer, so that the ESG risks, as they select and allocate assets, and as well as the proceeds selection, it is done with the ESG risks in mind to ensure that eligible categories of projects are identified, as well as assets, and managed transparently and prudently through the internal policies and frameworks on such matters. The management of proceeds, this refers to the mechanism in which the issuer will have put in place to ensure that the proceeds out of these projects are managed and tracked well, so that there's no reallocation to non-green projects or allocation to other projects that do not have elements to the categories that the issuer had already identified for their projects. Then reporting, this is just reporting to your investors on what you've done, what has happened, how many are the proceeds out of, the proceeds out of the projects and how they have been allocated or reallocated accordingly. Now coming to a bit of the lawyerly things. So we have local and global green bond reporting frameworks. As you'll see, there are many. This is an emerging area of practice, and it's yet to reach that level of maturity where we can say that they've been collapsed into one. Now, you'll note in here, these are more related to Kenya. So all these relate to Kenya. We have the Kenya Green Finance Taxonomy that was released by the Central Bank of Kenya last year, March. Before they had given, particularly because being a regulator of financial institutions and banks to be particular, they were given time to plan themselves, put the frameworks in place in readiness for reporting. But from this year, I think from this year, it has been made mandatory that they will start reporting in line with this framework on how the funds they disburse, the loans they disburse, particularly for green projects, how then they're being tracked. Then the same central bank in 2021 had released the guidance on climate-related risk management, which again, the financial institutions were required to adhere to. Closely, again in Kenya, the Nairobi Securities Exchange released the ESG disclosures. I believe we are all aware, for people practicing Kenya, particularly for PLCs, that it is now a mandatory requirement for listed companies to do sustainability reporting, and this one should be made available to the investors. Then we have another one that was released by the Ministry of Environment, the National Climate Change Action Plan. This is number 3 that replaced the one that expired in 2022, and there was an earlier one before that, which it keeps on improving. When you cross over to Rwanda, there's this that has been issued on the CMA of Rwanda on the issuance of green bonds, the social bonds and sustainability bonds, to guide particularly listed companies on how this is to operate. There's also the Rwanda Green Taxonomy working paper, and going to Tanzania, we have also quite a number, the capital markets, corporate and subnational sustainability bonds. We have the National Carbon Trading Guidelines, the risk climate related guidelines and disclosures, and also the environment management regulations, among others. And particularly, this is important for Tanzania, because Tanzania, I think in the East Africa, we can say it has reached some level of maturity in terms of dealing with matters of carbon credits. Then when you go globally, we have the ICMA, the Green Bond Principles, issued in 2021, which most countries have leaned towards it as they work on their frameworks. We also have the IFC Green Bond Framework. The EU has also released some, as you'll see here, as well as a number of others issued by the IFRS. As some of you will note, in Kenya, I think starting of this year, listed entities were asked, I think it's an IFRS or ISSB 1 and 2, ISSS 1 and 2, where they've been asked that in every reporting, and even as they factor in the risks, they need to factor the climate risk into their reporting. So now it becomes a little bit of a difficult thing, particularly for companies that have nothing to do with climate, or the operations have very little to do with climate, on how they report on that. And these frameworks are there to guide them. So the case for green bonds in Africa, as we've said, this is not something new in Africa. And we've seen a number of companies that have invested or have issued green bonds, and they have been successful. We have the Nedbank in South Africa that raised 1.66 billion South African rand, which was a 328% of a subscription for its certified renewable energy against its target of about, I think it was about 1 billion thereabouts. We have Akon Holdings, which also operates in Kenya. Akon Holdings, when it started out, it was the first entity in Kenya to issue a green bond and a climate bond for that matter. So this one, they leaned themselves towards green accommodation and such like things. And when they issued the first bond, Akon was able to raise 4.3 billion Kenya shillings. That's about $40 million US. For those who live in Kenya, I believe you've seen Kwetu, hostels, real estate, and Kejani. This is as a result of these climate bonds that are certified to be green and environmentally friendly by Akon. In Nigeria, we had an 8.5 billion, a 15-year loan for green energy that was issued by the North-South Power Company Limited, and it's been doing well so far. When you move to Tanzania, we see IFC investing its first green bond by CRDB Bank, and which was deemed successful. Again, recently we had the Tanga Water Green Bond, which was also successful. And out of this, you'll see the benefits that attract to a company by issues of this or being aligned to the ESG narrative. Number one is attracting ESG-focused investors. All these people who've invested their money here, it's not because they didn't have anything to do with it or put in other higher-yielding ventures, but it's because they want to see their money make a difference and impact in the environment and society that they operate in. There's also reduced environmental impact, negative, through direct contribution to climate change and improved standards of living. These loans, because they are yet to gain momentum, most of them, they attract a lower interest rate so that it can be appealing to investors. And then there's also a feel-good effect that just comes with such brands, and people want to associate with them. So as in every other place, anything that comes out, any regulation, guideline, whichever sector, there's always an opportunity for a lawyer. If there's nothing for a lawyer there, then it's not yet been drafted or it's not yet good enough. So some of the opportunities that we see for lawyers, as you noted initially, I said we have, like Kenya, we had like about 5 frameworks and regulations that are in place. Tanzania has like about 3. Other markets have none. Others, they're just there. So as a result of that, you find there's difficulty for investors to join a market or to penetrate a market because of the various competing regulatory frameworks. You don't know which one do I follow. So I choose to follow, let's say, the Kenya Green Finance Taxonomy, but then there's also the climate, then there's I don't know what. So lawyers play a crucial role in ensuring that the regulatory framework, the legal framework, the policy formulation, formulation is streamlined and if possible, put into one document to avoid competing or contradicting requirements. It makes it easier for investors to join the market. It makes it easier for people to know what needs to be done, where, when, and how, by who. It makes it easier to know, as I'm entering this market, who is my primary regulator? Who is my primary stakeholder? Who do I need to know? What do I need to do? But as it's now, with many regulatory frameworks, many legal frameworks and guidelines, it really becomes difficult for investors to penetrate a market. And that's where the lawyers play a role in ensuring that all these things are dropped into one or collapsed into one for seamless reporting and standardized management of such projects. As you do that, as you participate in the preparation of this legal framework, it is also your role as lawyers to ensure that the investors, the issuers, the policy, other policymakers are educated or trained, and as well as that is through sensitization on how these work. There's always a notion that sustainability is too expensive or I'm too small of a company to do this. Now, the lawyers will come in and play this role of educating our issuers, educating our investors on the importance of sustainability, sustainable finance, how it's helpful to them, what is in it for them, and how they make an impact by investing in this sector. Tax incentive, this has not come out prominently, particularly for many markets where investors or issuers get a tax incentive for participating or investing in the ESG sector. So whatever tax I'll pay as another financial institution is what I will still pay if I was having an environmentally linked bond, and there's need to attract people into this by ensuring that we have good tax incentives. Deal structuring. Other people may do documents and all that, but ultimately they'll at some point land on the lawyer's desk before it's signed on the dotted line. And so a lawyer will play, as lawyers, we play a crucial role in ensuring that the deal structuring is done well. We advise our clients, we give them a 360 on everything that is required, from legal and policy framework, from transaction costs, from to our stakeholders, the primary regulators, the primary advisors, and such like things in terms of the deal structuring. As lawyers, again, for those who deal particularly with financial institutions or those that give financing for such projects, you can lend your expertise in ensuring that policies are in place to prioritize lending on the ESG projects, and to ensure that it is an easy space for an investor or a person who wants to borrow money that is ESG products linked. It's easier for them to access those funds by ensuring that the policies are streamlined, they're easy to understand, and that there are no many red tapes that are attracted to it. I think with that, in the short time I had to rush. I'll leave it at that, and we'll take questions at the end of the session. Thank you so much, and to you, Ellie.
Thank you very much, Doris. We appreciate your presentation. Colleagues, you will note there's a running Q&A session going on in the Q&A section at the bottom of the screen. Please continue to post your questions there. The panelists will answer them in real time. Alison, I believe, is now ready to proceed with her presentation to us. As I had mentioned, Alison is the legal manager at the Uganda Capital Markets Authority, where she's in charge of the CMA's regulatory framework. And she's an experienced in-house counsel and governance professional in Uganda. Alison, thank you for being with us this afternoon. The floor is yours. You can proceed with your presentation.
Thank you, Ellie, for the kind introduction. And a good afternoon to everyone who has joined the call, and my fellow panelists. My apologies for the earlier glitch. I did have some connectivity challenges, and as a result, I'm going to kindly request that I keep up my video, as it may affect the bandwidth. I had also prepared a PowerPoint to guide us through the presentation, but it may not be possible to share it without interruption. So if you could kindly permit me to share with the Secretariat, who can circulate after. My apologies. I hope that is acceptable.
Thank you, Alison. You can proceed.
So when I received the concept note for the webinar and went through the proposed discussion area, which is fintech and digital markets, specifically the legal opportunities for lawyers in innovation, I thought it was a good call as a focus area, because we can all agree that tech and AI evolution, with tech and AI evolution, it's no longer business as usual for most professions, the legal profession being no exception. And so I'm happy to share my thoughts this afternoon on how this has impacted particularly the capital markets, and as professionals, how we can pivot or position ourselves to really take up the new opportunities that have come with these changes. Now, before I delve into the discussion on opportunities, I thought it would be important just to have an appreciation of what are the key developments in fintech and digital innovations within the capital market space. And I would like to take us through this from two viewpoints. One, from a market operations perspective, what are the innovations that are currently manifesting within the market from an operational perspective? And then from a regulatory standpoint, how are the capital markets regulators responding to these developments or catching up So from a market operations perspective, you want to look at two sides of the market. Like any other market, the capital markets is really premised on the fundamentals of supply and demand, the concept. And as you know, capital markets are simply platforms that bring together or connect those that are seeking capital and those that have capital. So as any other market, you have the supply side. On the supply side, you have investors. These may be retail investors like you and I, or institutional investors like the pension funds who have some disposable income that they would want to invest and are looking for a worthwhile investment opportunity. And then on the demand side, you have companies, you have governments, you have state-owned enterprises that are looking for capital to grow their businesses, to implement their business expansion strategies, and for the case of central governments, to fund national budgets. So what focal points would I like to highlight in terms of the innovations that are coming up? When you look at the demand side, which is those that are looking for capital, I'd like us to look at the issuance process. I believe the previous speakers have talked about IPOs and that process of seeking capital, raising capital. If you look at the recent past, you realize that increasingly public offers are more of a cross-border nature. You'll have IPOs. If we look at just our respective jurisdictions, you'll have an IPO, say, in Uganda, but it is marketed in Kenya, it is marketed in Rwanda, in Tanzania, so that it's able to build that critical mass to fill a subscription, but also benefit from a wider and more diverse market. And what this means is that you must have efficient delivery mechanisms to support this diverse participation across the different jurisdictions, because it is now a critical success factor for public offers. And if you're going to run this public offer simultaneously in the different jurisdictions, you must be able to support potential investors to subscribe for the shares seamlessly, to pay for those shares, to be able to allot those shares in the shortest time possible post the IPO. And technology has played a very critical role in making this happen. If you think back, before these innovations began, subscription participation in an IPO, you have to walk to your broker, you have to print a form, you have to submit the form, take it back home, put your KYC. But technology has transformed this landscape, and by providing an end-to-end process in participating in these capital raising processes. What are the game changers? You have the mobile phone. All of a sudden, an issuer has access to over 200 million mobile phone users. I saw that in a report. If you look at the East African region, I think in terms of mobile phone penetration, we are over 200 million phone users. So you're opening up to a market that has that number of people, and they're able to simultaneously and without necessarily having external help participate in this process. Using both USSD applications and web-based applications on that phone. The second game changer that I would highlight in this space is the payment systems, and how innovators have been able to integrate these payment systems with the mobile phone to the banks, again, to be able to seamlessly support the process of being able to participate in an offer, being able to pay for the shares that you're subscribing for the issuer that is involved, being able to make any necessary funds, being able to consolidate all these monies that are collected through the capital raising process. And similarly, when you look at the treasuries and bonds market, it's really, again, a factor of integration of payment systems and being able to reach the last mile man in terms of access to the mobile phone, whether by USSD or web-based applications. Again, capital raising, we have crowdfunding models mainly used by the SMEs who don't have probably the luxury of doing public offers like our conventional blue chip companies. And you'll realize that the crowdfunding, which is usually project-based, is always almost run on digital platforms. So this is another area that I would like to highlight in terms of focal points of innovation for the market. The second area on the supply side is products. Now, leave alone the process of raising capital, which I was talking about. Now, in the area of products, you see an emergence of more tech-based products. We see the emergence of tokenized securities, and we see new securities that, like the stablecoin, the Bitcoin, that are performing, competing with traditional conventional capital markets products. And this is an area that is really supported by technology tech. That is also another game changer within the capital market space when you look at the demand side. Now, moving to the supply side, which is the people that have the capital, that are supplying the capital. Investors are also going through their fair share of exposure to innovations. Our typical market innovation in the past has centered around exchange platforms. So facilitating buying and selling of shares on the secondary market, of course, enhancing liquidity, and this includes across the borders. For instance, we have the African Exchange Linkage Project that was launched about over a year ago. And essentially, this is meant to facilitate cross-border securities using an order routing system that channels orders between different stockbrokers across the region or across different jurisdictions to participate in the exchanges within the continent. And we also have something that is being simulated within the East African partner states that are looking to apply a similar model for the East African market as a regional bloc. So again, being able to connect stockbrokers so that different investors across different jurisdictions can participate in different markets without necessarily having to deal with a particular broker in the market. But above that, business as usual innovation that has been what has been the majority of innovations in the market, we have seen some novel focal points of innovation emerge for the investor. For instance, when it comes to investment advisory support, we are moving into the era of robo-advisory. We are seeing increasingly development of products or services that utilize algorithms to help you track your securities of interest, to tell you when to buy, how much to buy, when to sell, with minimal or no human intervention. And these are mainly developed as self-service portals, and really challenging the traditional intermediary models that we've been accustomed to. In terms of product distribution, again, we're seeing adoption of more self-service based portals, and intermediaries are also looking at developing one-stop centers for their investor clients so that a client is able to have a view of the entire investment portfolio tracked on a single portal with a self-service model. You can print your statement, so you have registry services, say in your phone, on your laptop. You can make an order to buy or sell securities that you have within your portfolio that you're looking to acquire. And of course, I'll mention again the payment systems, because this has played a huge role, being able to integrate the mobile phone wallet to intermediary banks and vice versa to make the investing process as seamless and hassle-free as possible. Innovations that are relevant for the investor today that we are seeing increasingly being picked up within the different markets. Then I'd also like to highlight the area of meetings, virtual meetings. While it now seems very normal, let's not forget that not more than 5 years ago, as a shareholder, if you really wanted to participate in an AGM where you invested as a company, I'll give an example. For instance, if you invested in Kenya, say Safaricom, and you're Ugandan or Tanzanian, you had one of two options. Either you make the journey to the venue at your cost, obviously, or you look for a relative who lives in Kenya and appoint them as a proxy, which in itself was a process because you'd have to fill in the proxy form, send it to the company secretary, wait for acknowledgement. But today you have an opportunity to fully participate, vote, ask questions, because almost all public companies have adopted a virtual or hybrid model for delivering annual general meetings or extraordinary general meetings. I recall in Uganda at that time, this was during the COVID-19 situation, it was a very painful transition process because you had a majority of companies whose memorandum and articles of association were modeled on the articles of association provided for in our Companies Act, which only made reference to physical attendance because they did not envisage the virtual meeting scenario. And so companies that had adopted this phrasing without modification had to go through the process of obtaining court orders, permitting them to recognize virtual attendance, first to be able to amend their articles, and then subsequently to hold the AGM. So these are some of the more recent and key areas of innovation that I wanted to highlight as we set the stage for discussion in terms of the opportunities for lawyers. And before I proceed to the opportunities, just on the regulator side, how is the regulator responding in terms of these innovations? So from a product innovation perspective, I think we've seen quite a bit of an emergence of regulatory sandboxes in response to the rapid growth of technology within the capital market space. And so the complaint that the regulator is always playing catch up may very well soon be a cry of the past, because what do regulatory sandboxes do? Essentially, they allow the regulator promote innovation by allowing experimentation of new and innovative products or distribution models within a clearly defined space and time, while providing the necessary regulatory support, but at the same time learning about the new product, the risks that are associated with that product, evaluating how best the regulator will regulate this new product, whether there is need for a new regulation altogether, or whether it can fit within the existing regulatory framework with maybe some modifications, but which may not require significant amendment to either principal or subsidiary legislation. Within the East African market, I know that Kenya was leading on this. It launched its sandbox in 2019. Uganda is expected to roll out its new regulatory sandbox before the start of the new financial year that starts in July. I don't know whether Adele is still on the call. She would have spoken into where Tanzania is at, but I do know that there is some work being done in that space as well as Rwanda. But all this is really to make sure that there is a balance between monitoring the risk that comes from these new products, while at the same time supporting the innovation, because the regulator is becoming increasingly alive to the reality that these innovations are here to stay with us. They are fast-paced, and so while we may not be able to anticipate each and every regulatory framework that would fit every new product, it's important to create a space through which we can facilitate these innovations, while at the same time monitoring the risk and planning for how best a regulatory framework can be developed to support its regulation as a product, a service, and the participants going forward. Still on regulatory response, recently in March 2025, IASCO which is the International Organization of Securities Commissions organizations, and which is the global standard setter for securities regulation. It has a membership of over 95% of the world's securities markets, covering at least 130 jurisdictions, released a report. And the report was advising on use of AI technologies in the capital markets and impact on investors globally. I thought it would be important to highlight that one of the key things that came up in that report is just generally the question around whether our current regulatory frameworks at a global level have the capacity to address the unique risks and investor protection concerns posed by AI. So in the near future, we may see a number of regulatory developments arising out of this preliminary review of the risk that is posed, the unique risk that is posed by AI, and which review is going to subsequently inform the regulatory approach across various jurisdictions in dealing with the issue of AI. So this is work in progress, and it should be anticipated as practitioners. Now to the question of the day, having highlighted the above focal points of innovation for the market, what are the opportunities for lawyers? Number one, product structuring. I know there's been a discussion around the deal structuring, but with the new products, I had talked about tokenization. And what is tokenization? This is really a process of converting rights to an asset. It could be rights in shares or bonds or real estate into a digital token, mainly using blockchain technologies. And these tokens, which are now assets, can be traded like traditional securities. So there is an opportunity for legal advisors to guide stakeholders in structuring some of these products. One of the things that I would highlight is when it comes to new products, and most of these products that are tech-based, and most of the products that are using blockchain technology, is we do have different approaches in different jurisdictions in responding to these products. You'll find jurisdictions that don't have, where the law is silent. You'll have jurisdictions where there are gray areas. You'll have jurisdictions which have made a statement not recognizing certain products, certain virtual assets and digital-based products altogether. For instance, jurisdictions which have rejected, say, for example's sake, Bitcoin, in terms of recognizing it as a tradable security or a tradable currency. So as a legal advisor, it's important to interest yourself in assess, from a product structuring perspective, to assess the position of a particular jurisdiction where a client may want to market such a product and its position on digital currencies, virtual assets, and their ability to be offered in that particular market as recognized securities. As I mentioned, we are at different levels of adaptation, and it's important that for each jurisdiction where that new type of security would want to be marketed, or depending on where the client is setting up shop, that the principal legislation that recognizes these new assets is actually something that is either clear, or in the event that there's a lacuna, then also just being able to understand whether it is still possible to market that particular product as a security within that jurisdiction. The second area I would highlight as a dynamic legal frontier opportunity is fintech compliance. Patricia, I think, spoke about compliance in detail. So I'll just make a few highlights because some of the points she had mentioned. We now have to look at compliance, for instance, with regulatory sandbox requirements. As I'd mentioned, the regulatory response when it comes to innovation, as we are seeing across the different jurisdictions, is the application of regulatory sandboxes. Now, these sandboxes, the way it works is they'll have specific guidelines or requirements for the different products. And it's not a one-size-fits-all. The requirements for participation in the sandbox and being able to successfully exit will be made specific to a particular applicant, and depending on what kind of innovation they're trying to bring into the market. So as many jurisdictions are piloting these innovation frameworks, legal experts can help fintechs understand what is permissible, help them appreciate the full scale of the compliance requirements that the regulator is communicating to them as an applicant, help them understand the implications of participating and what it means to successfully exit, and probably the consequences of non-compliance, even while you're participating within the regulatory sandbox framework. It's a new developing area, so the opportunity lies in being able to quickly come up to speed with how the sandboxes work. Different jurisdictions may have different models, but being able to translate these requirements to the client in a practical terms, what it means for them for being able to be accepted to participate, but also maintaining their participation and their eventual exit from the sandbox into a fully fledged product within the market successfully. The second area from a fintech compliance perspective would be the area of anti-money laundering and KYC, know your customer. I believe Patricia spoke to this. Just to highlight that as the fintechs evolve, the standard for compliance in this area is increasingly becoming high. So being able to advise on the proportionality of the due diligence, proportionality of compliance with the AML requirements for these platforms that are being built by innovators would be a critical, it would be an area of value add as legal counsel. I must admit that while it may seem easy at a practical level, it may be a bit challenging, because how do you balance the need to make a process as hassle-free as possible, but at the same time ensure that the process captures the essence of what your anti-money laundering laws say. So for instance, in terms of collecting KYC from non-residents, from non-nationals, and it becomes a bit more difficult where you find systems that are not integrated when it comes to, say, for instance, your national identification documents being integrated at a national level or at a regional level, and maybe you don't have similar documents used across, or electronized documents used across the region or even within a particular jurisdiction. So being able to navigate those requirements, making sure that there's that balancing act between the innovation and trying to make it seamless, but at the same time making sure that those innovations, especially the first steps of registration and onboarding the customer, capture the essence of what is expected from a KYC perspective and AML perspective. Then you also have, again, under fintech compliance, licensing compliance. With fintech services, I believe what most of us could have observed is that the categories are often blurred. You'll find that you have multiple regulators, so to speak. And so even at the point of seeking regulatory approval to get a license, while you may have a primary regulator, you probably may have 2 or 3 other regulators that you'll have to engage with, whether to get a no objection because of the integrated scope of the business models. So you'll find that you require approvals from multiple regulators due to the integrated nature of the product and the platforms. And even post-licensing, you may have license obligations that cut across different regulators. So as legal counsel, there's opportunities there to be able to support the client seamlessly and in a timely manner, being able to meet these parallel licensing obligations, both at the licensing point, but also post-licensing. Second last, in the area of data privacy and protection, this is also a new and emerging area. Data consumer as a currency in this digital age is really powering the tech space. And in the digital age, you find that the customer data, while it's a currency now, it also raises concerns around misuse and consent. So being able to structure terms and conditions for the use of this platform that take into consideration that data privacy requirements and concern as legal counsel will be a point of value. I think this is further complicated by the global nature of our markets, where you have participants from different jurisdictions that may be interested in participating in a particular market. And you need to know that there are certain regulatory regimes which are more stringent and restrictive than others. Say, for instance, the EU data protection laws tend to be a bit more stringent. So if you have a client that, say, is from the EU country but wants to participate in a particular market, say, for instance, in ESC, you will be of value if you've interested yourself in the unique data privacy and protection compliance requirements under this regulatory regime. But aside from that, I believe as counsel, you can still deliver value through drafting compliant privacy policies, managing cross-border data transfers, and building robust cybersecurity, supporting building robust cybersecurity strategies with your client. Another key opportunity would be being able to interpret the gray areas and advise on technological safeguards, and just mediating between innovation and data protection, because that can be a thin line, especially when it comes to marketing of some of these products. Finally, on opportunities, areas where we have opportunities, I think it would not be fair if I do not mention contracts. Technology now, we have smart contracts. And what are smart contracts? These are essentially self-executing agreements that are written in computer code, primarily stored on blockchain. Take an example, say, of a vending machine. Once you have met the requirements necessary for taking the necessary action, then the transaction self-executes and it is deemed that the contract has been agreed. So as a lawyer, as we're seeing these increasingly being integrated in the day-to-day business transactions, I think opportunities majorly lie in advisory. One, you need to be able to look at the nature of the transaction. Is it one where the agreement can be fully automated? Just looking at the nature of obligations and conditions related to the transaction or the arrangement. Secondly, from a legal recognition perspective, are there challenges? Are smart contracts enforceable under the current contract law of your jurisdiction? Can code replace intent when it comes to legal disputes? And this is really a question of jurisprudence for a specific jurisdiction. So you will add value if you're able to address your mind to these elements for your client. Other considerations, I don't know whether we have tax practitioners on the call, but issues of taxation, because of the cross-border nature of capital markets transactions, have a relevant bearing on the different, being able to have, being able to holistically manage legal risks that are arising out of these transactions. And then the issue of transfer pricing. I believe we've all noticed that as more entities are looking to maximize economies of scale, oftentimes you'll find that business entities are carving out fintech subsidiaries. And these fintech subsidiaries are focused on developing platforms, which they then distribute to their associated companies. Now, you need to be able, as legal counsel, whether you're in-house or externally brought on board, being able to advise the client on the implication of these arrangements from a transfer pricing perspective. Also, as you're drafting the contract, would be an area of opportunity and an area through which you can add value. Finally, I know I had said finally, but this is the finally, Ellie. Shareholder activism. I think I had mentioned the issue of virtual AGMs and over the past 3-4 years, how this has evolved. Now, with the increase of digital platforms, you find that shareholder coordination has now become easier. We don't need to know each other to caucus or to agree, because provided we have similar pain points, this can be hashed out on a digital platform. South Africa is leading in the continent when it comes to shareholder activism, but we have seen, for instance, Kenya, a growing awareness, particularly among the retail investors and civil society groups, which are pushing shareholder interventions and really being a tool of promoting transparency and ethical governance. And for the public listed companies within the East Africa region, we're still seeing activism as the capital markets deepen and more companies list publicly. What are the opportunities in this space? As a lawyer, you can advise on corporate governance reforms. We have teams that support the board and management teams, strengthen governance frameworks. This is a key point of value. You can support draft shareholder engagement policies. This is an emerging trend, making sure that there are clear frameworks for engaging shareholders, that it is known internally, but also known by shareholders externally. On the flip side, lawyers can also represent activist investors that are seeking to influence corporate behaviors, but also actively participate in dispute resolution and litigation for those of us that are in the litigation space. Finally, I want to end with sharing at a more strategic level, legal counsel has a role to play in shaping the future. Just being able to bridge the gap between tech developers, regulators, and consumers, because we have a unique advantage point. You're able to see the issues from 3 advantage points: from your client, say the developer. You have the technical expertise to navigate regulatory frameworks, but you also have insights as a potential consumer. So you're well placed to be able to bridge that gap and make sure that both in terms of legal risk management, but also being able to be fully compliant, you are able to advise the client. Also, in terms of positioning yourself as a thought leader in the innovation space, we're able to anticipate regulatory trends, such as in AI governance. And with this, we're also able to identify the legal risk management mechanisms and other consumer protection mechanisms that we can incorporate as our clients are innovating. And then finally, the ability to position ourselves to influence policy and regulatory development. I believe legal counsel, by virtue of their trusted position, can meaningfully shape legislation through advocacy, collaborating with regional bodies. Adele talked about the EASRA body. We have the ESC, the COMESA, our own professional bodies such as the ELS and the law societies of our respective jurisdictions. are able to influence policy around this novel area, so that we are ahead of the game and we were able to provide, to give this value add from a legal advisory perspective. I thank you for listening to me. Ellie, over to you. I'll be able to answer the questions in the chat group. Thank you.
Thank you very much, Alison. Just to give us some time, since we seem to be running a bit behind, I directly hand over to Charles Mabiru, who is a security and investments lawyer in Nairobi, and the founding partner of M&A Advocates. Charles, I will request that you quickly take us through the presentation, what we can release our colleagues by 4:15. Thank you.
Thank you. I hope I'm audible enough. Eli, please confirm that.
Yes, you are.
Okay, wonderful. So, my bit is on digital markets and cross-border. Okay, my bit is on digital markets and cross-border transactions and integration of the ESC. So, the question then that came to my mind was, which market guarantees that we include all these various topics in the question? So let me first begin by introduction of ideally what is a market. So a market is a place where buyers and sellers come to meet, and ideally the whole idea of a market is to ensure that something that my university banking law professor used to call the twin problem of moral hazard and adverse selection. So what happens is that in a market where there's no free-flowing information about the cost of products, what happens is that there's something we call information asymmetry. So information asymmetry is that some people have better information than others, so they're able to price products better than other people. So what happens is that it brings about the problem of moral hazard and adverse selection. Moral hazard is just people acting illegally, stealing. So for example, if I know, for example, that a certain vehicle has a defect, I don't tell the rest of the market. So that's moral hazard. Whereas adverse selection mostly affects regulators. So because there's no free-flowing information about a market, the regulator sometimes will focus on one area and leave another, and that's what brings about market crashes. So markets are divided into three in terms of regulation. So we have the self-regulated markets, we have the ones which are quasi-regulated, and we have the ones that are fully regulated. Anybody who wants to understand about the various types of regulation can look for a paper by Dr. Gakeri Jacob in 2012, Regulating Kenya Security Markets, an assessment of capital markets, authority enforcement jurisprudence. He's, I believe, serving as a judge of the High Court, I believe in the Employment and Labor Relations Division. And on the discussion of moral hazard and adverse selection, I would encourage people to read a paper by Anurag Gupta, a 2009 paper on moral hazard and adverse selection in originate to distribute model markets or a model of bank. So those papers are available online, and if you need, kindly let me know, and I will share those two papers. So markets ideally are for the purpose of price discovery. So what happens is that when people come to the market, they're coming because they want to know what is the best price I can get for this product. When you're in the bush, you can negotiate for a higher price or a lower price of a market of a product, and sometimes you get conned or unable to get a good price for your market. So what are the various markets we have in our region, in the East Africa region? So, and markets, of course, go with products. So we have commodity markets, which deal with tea and coffee. We have equity markets that deal with shares, money markets that deal with bonds, and then we have the derivative markets that deal with futures. Then we have the over-the-counter markets that deal with crypto. And then we have CFDs. These are contracts for difference. These are the ones that you hear people talking about, the forex markets. They are mostly dealing in CFDs. So if you'll indulge me, I want to take you through all of these products and how they are traded, and what exactly happens and where they are traded and what is the process. Okay. So beginning with tea. So in order to understand how tea is traded, we visited the Tea Brokers East Africa Limited. This is a broker registered with the East Africa Tea Traders Association. So the East Africa region has a Tea Traders Association. So this, for me, fits into uh, in the discussion of today, because basically it includes every aspect of what we want to look at. A market that brings about cohesion and integration in our region. So we attended auction 24, which was on Monday and Tuesday of this week. And so what happens in that market is that they have two trading days. They have day one and day two. So on you'll find that on Tuesday they'll do the secondary market, and on Monday they'll do the primary market. So let's say secondary and primary. What I mean is this: there are some main grades that tea is graded in. So these are the main grades are the ones that are more preferred. And then the secondary grades are the ones that are not preferred but still are produced. So for example, when you buy Ketepa and you imagine that you try to imagine, what am I taking? Am I taking a high grade tea? Or am I taking a low grade tea? Most of our teas are blended based on what the buyers will want to do and what calculations they have made. For example, I was told that Ketepa is Fagins one. That's a secondary brand, and Dust. So there's a grade called Dust in Fagins. They blend them together, they put them in Ketepa, and they still sell. It doesn't mean that Ketepa then becomes a low grade commodity. In fact, in the warehouse in Shimanzi, I saw a whole pallet of tea, Ketepa tea, being shipped for the American market. So this issue, what happens is that the grades are often based on marketability, but it doesn't mean that the other grades do not sell as much or as well. So the Mombasa tea auction, where I was, serves Kenya, Uganda, Burundi, DRC, Rwanda, Malawi, and Tanzania and Ethiopia. So tea, just like every other commodity, is sold through bids and asks. So the broker who is selling the tea will do a bid and the buyer will do an ask. So it's good to understand how tea becomes tea. So what is the process? So of course there's the plucking of the tea. Then after plucking, it's processed through withering. Then there is a CTC, which is culling, tearing, and cutting, tearing, and culling, a very important process that is primarily for the Kenyan market. Fermentation, drying, sorting, packing. So it's good to mention that at this point of fermentation, the tea is called thul. Thul is an Indian term to describe tea. Then it is dried, sorted, and packed into 40 kilogram or 20 kilogram packets. So one of the responsibilities of the tea producers is also sorting the tea, because they will sort and pack it, and it will come to the warehouses in Shimanzi from as far as Rwanda, from as far as wherever. It will come packed, so that the producers of the tea are the ones who grade it. They will put a grade on it. So finally, it will get to the warehouses, and the warehouses, their work is to inform the brokers who serve in the market that the tea has arrived. Then the brokers will unpack, and they'll send the broker. The warehouse will send the broker a 4 kilogram sample, which will be broken down into 200-gram portions that will be sent to the buyers. So the work of the buyers is to sample the tea, see whether it meets the standards that they would like, see whether the producers are correct in how they graded the tea. As I've mentioned, the main and the secondary group. Then from there, the broker will create a catalog, which this catalog is a very comprehensive catalog. But this is how the specific tea will be graded. Sorry, will be sold on the market. So the broker will also send samples. The broker will also do internal testing. So the testing process is very long, and we did testing of about 300 different samples of 300 different teas. By the time you're done with the testing, the back of your mouth is completely dry, and it's not easy. But nonetheless, that's the work of the broker. They test the tea on behalf of the buyer, and also it informs them whether the tea is of the quality that ideally they would need to sell. So at the auction, as I said, the broker will bid on at the auction. The broker will bid on a specific tea using a specific mark. So the marks are basically the clients or factories that are producing these teas. So the buyers know them through the marks. So that is how they shall appear on the market. The unsold tea, because sometimes you'll put the tea on the market, is sold back again through something called a reprint. So reprint 1, reprint 2, and so on and so forth. After purchase, the broker will send the buyer samples which he has purchased. So tea from outside Kenya, that is a tea from the rest of you guys in Rwanda, Burundi, Tanzania, will come, and KRA, customs, will give something called an entry, which again will be used in the process of selling. So it's good to mention that the broker is supposed to receive a commission of 0.5%. The producers are supposed to get 0.75%. And after payment, the most important document in this transaction is called a delivery order. It's a very sensitive document, but this is the document that the buyer will be given by the broker to go to the warehouse and get out their tea. So what happens at the once the tea is sold? So what happens is that some buyers will just take their tea from Shimanzi and take them to secondary warehouses. They can blend the teas depending on what makes sense for them and their margins and their whatever. Now, the only tea that is not blended is that one that comes from that one that is going to the UK. But otherwise, our tea in this region goes to Pakistan, UAE, Egypt, and all this is normally blended and packed. So it goes as a packed item. Yeah, so if a buyer is unable to, so what happens if a buyer has asked for a certain consignment of tea and is unable to pay for it? They'll be given a penalty because the tea will have to be resold again on the market. If the tea is sold for a higher price than it did before, then the benefit goes to the producer. And if the tea sells under, then the buyer must come up with the money to make up the difference. Yeah. So, how does this market work, and how does it integrate all of us? So, there's the East Africa Tea Traders Association. So, this is an association that all of the member countries have come together. They've joined, and they have a rule book. So, ideally, as I mentioned about self-regulated, quasi-regulated, and fully regulated, the EATTA is a fully regulated. Is a self-regulated organization. They have their handbook. So then, where would you come in as a lawyer in this specific market? So as you're the contact person when the public wants to get into a certain market. So when it comes to, for example, registration of a company that will ideally become a broker, you will be the contact person who will have to possibly understand how these processes work. And beyond that, you'll be possibly the contact person who will explain to this person, your client, how the tea is sold, how it is sampled, and possibly the kind of finances they need to engage in order to join this market. It's good to note that right now the best quality tea is coming from Rwanda. So I noticed that when everyone else had sold their tea, when the Rwandese tea came on, when it was their turn to sell, when it was turn for Rwandese tea to be sold, the prices they started going up, really up. When the rest of the tea, even the high graded tea, is going for $2 a kilo, the Rwandese tea was going for $4, $5 a kilo. And I'm told that Rwandese are very good at growing tea, plucking two leaves and a bud. You guys are exceptional, and at least they noted that. Um, and also for the bit about lawyers. So another area that lawyers do come in this market is conflicts that come up in the warehousing. As you'll notice, the physical commodity is kept in the warehouses in Shimanzi. So sometimes the way the tea was packed, maybe even from the producer, there's a height limit, there's a width limit, and when it's put on the ship, sometimes it takes up too much space, sometimes it takes too little space. There are those parameters that it needs to follow. So there have come up many conflicts between buyers and transporters, that this consignment, this pallet is has too much tea, and then of course there's the issue of the tear and wear, or the tea arrived and it was not properly packed, and so on and so forth. Of course, as you've seen, there are some conflicts that come in with payments. Sometimes you buy in the market and you're not able to fulfill the payment, but the most important bit for your client is on one specific issue, which is settlement. Because in all this, the question will be, if, for example, you're dealing with a producer, these people who are growing the tea, so how do I get paid? And that is settlement. So the Mombasa Tea Auction uses an automated system, which allows for direct settlement. There are two banks that are involved, that is Equity Bank and Stanbic Bank. So what I can say is that tea market is extremely data driven. They are extremely sophisticated and they're extremely digital, which means that if, for example, you're coming from as far as Malawi, because they serve very, very, very many markets. So imagine that you're coming from as far as Malawi. You will get your payments. Settlement will happen in your favor because the two banks are there and they have a system, which I saw, which means that you will get your money. So the East African Trade Association has 16 brokers. So that concludes tea. Then we have coffee. So coffee has 11 registered brokers. They conduct the services on behalf of on behalf of the farmers. So what simply happens is that the brokers, they get they act sometimes on behalf of cooperatives, but we have some coffee farmers who also have direct access to the Nairobi Coffee Exchange. So they just go directly to the coffee exchange and they are able to access services and they're able to sell their coffee. So the question is then again on settlement. How then can a farmer get their money, or cooperatives, how are they getting their money? So the CMA regulations have required the coffee exchange to set up a direct settlement system again. So these ones are quasi-regulated. They are quasi-regulated entity. So it's also important to note that the broker gets a percent, the coffee exchange gets 0.3% of the fee, and CMA gets 0.2%. Again, on payment, there's a period of, just like tea, there's a period of 5 to 14 days for you to make sure that you've completed your payments. And if not, of course, penalties do accrue as they should. This DSS system, money goes through a cooperative bank. So the farmer has a direct access to the exchange. Of course, the coffee exchange is the most vibrant exchange in the region. Right now, we are seeing prices of about $400 for every 50 kilos. That's about $8 per kilo. That's even higher than tea, because tea is averaging $2 right now, $2 a kilo. So for the coffee exchange, the Nairobi Coffee Exchange are very interested in increasing their volumes, and specifically for one reason. If they have volume, they can offer financial products like derivatives, such as futures, in order to grow and deepen their market. So they told us that they are inviting the region, and they mentioned Uganda. They said if Ugandan farmers would be willing to trade on the exchange, it would be good, because other than Ethiopia, who are doing very good volumes in terms of coffee, Nairobi Coffee Exchange comes next. Coffee used to be a huge commodity in Kenya, but it was a lot of people are replacing coffee for real estate. But coffee is making a huge comeback. So moving on, we have the central depository system, and it's good to mention maybe about coffee, as mentioned by all my previous colleagues who've spoken. You'll notice that these markets have a lot of areas of potential conflict. So of course, for coffee, if you're approached by a customer, of course there is the issue of how do I approach this market, how do I join this market, how do I become a broker, for example. So it is for you to go to the CMA rules, read and understand and explain to your client, and then understand the scope of the market, as it were. And of course, there are conflict areas, especially to do with the warehouses, the brokers, and even the farmers. So those are other potential areas that lawyers can jump into. So the next player in this market is the Central Depository and Settlement Corporation. So they deal with settlement specifically of shares sold at the Nairobi Securities Exchange, and specifically corporate bonds. So upon opening your account, they'll collect KYC details. You can, before we used to do them physically, you'd go to your broker or your investment bank or even your commercial bank, and you'd fill in the forms physically, and they would collect data that way. But today you can open an app and easily get an account. But for lawyers, this is important information. So they explain that in the event that, for example, you have an account and the names that you registered were not in the order that you wanted, or in the event that a client was to approach you and tell you that my CDS account has a problem in terms of how the names are ordered, they say that they would have to set up a new account for you, because not even a deed poll will work. So it means that that means that even if they come to you saying that would like to do a deed poll, it will not, for them it does not feature. Another important point for the lawyers is that the CBSC facilitates something called pledging. So what is pledging? Pledging is when you have securities, when you own securities such as shares, and you want to get a loan with them. So like, for example, what happens with land, where people are able to access facilities, and they use the land as collateral. The same can be done with shares and bonds. So the CDSC is responsible for that. It takes about 2 days to pledge. You approach your bank, you tell them, I would like to get a loan. I have shares worth this much. And because of that, I have shares worth this much. And because of that, what happens is that, okay, I would like to get a loan. The bank will approach CDSC, and they will confirm that it's indeed you do own these shares. And then, therefore, they will value the shares and give you a loan worth about 60% of your holdings, 60 to 80% of your holdings. And of course, they'll do their own internal valuations, even considering the CBK rate. And from there, you'll be able to access your facility. So, of course, this being a financial facility, you might be approached by a client or on advice on how that would work. So it works for both shares and corporate bonds with regards to the CDSC. Another thing, another area that lawyers do come in with regards to CDSC is private transfers. So there are two types of private transfers. We have the gifts. So these are during succession, after succession proceedings have finished, you can approach the CDSC and have the shares transferred. So this gifting is specifically for heirs. You cannot transfer to your friends, relatives. You cannot transfer in order to do to replace them for a vehicle or any other transaction you may imagine. This is specifically for heirs. If you want shares, you just simply go to the exchange. So there is also transfers between companies. This is during mergers and acquisitions. But for those ones, you'll need CMA approval because for such transactions, they're done in block trades. So you will definitely need to engage the regulator. But for those ones for succession, you just go directly to the CDSC and you're able to effect those transactions. So what happens for you to be able to purchase shares at an account? You fund it. Then once you fund it, you talk to your broker. You buy the shares which you want based on the price. You can only buy a minimum of 100 shares anyway, but it's good to know that information. So of course, these transactions are in two types. There's T+3, that's transaction date plus 3 days, and then there's T+1. And in rare occasions, there's T+0, which means same day transaction. So again, we go to settlement. So settlement is the CDSC, of course, are in charge of settlement, but how they come in is simply once you've bought your shares, the information is shared with CDSC, who will share it with the central bank. This settlement process can happen about 2 times in a day, morning and afternoon. But ideally, that's how settlement works. So central bank will confirm that indeed the money has been transferred from the bank account. So therefore, the transaction will be deemed to have been complete, and CDSC is responsible for keeping those records. So lawyers, ideally for CDSC, can come in when it comes to transfer of shares and through succession. And it's important to note that in the event that you are given instructions by a client to go to the CDSC, you'll not get far. Unless you have a power of attorney, there's really not much that you can engage in because they want clients to go there themselves. So for you to be able to act on instructions given by a client, you need a power of attorney. CDSC connects very well with Nairobi Securities Exchange. So one of my colleagues has talked about the African Exchanges Linkages Program, which they talked about, and the East African Securities Exchange Association, and the 20 East Africa Exchange Index. So these are all attempts at trying to have all of us in East Africa come together under one umbrella, as has happened with T. But unfortunately, we don't have a consensus on that. Neither do we have a concrete framework on cross-listing. But you will see it happen. Like, for example, one of the best performing shares, I believe, last year was Umeme. Umeme is a Ugandan company, but it performed very well on the Nairobi Securities Exchange. I saw something like about 104% in terms of increase in price. Another area that is a gap is when it comes to SACCOs. You know, those people who invest in SACCOs have shares. Now, unfortunately, when you have shares, you cannot transfer them to someone who is not a member of the SACCO. And that's another area that lawyers can come in. The exchange is looking for enabling regulations and advice on how we can move from an area of basically when someone loses their money, because if you can't find someone within the circle to sell the shares to, unfortunately those shares will disappear. So the Nairobi Stock Exchange is the largest. The Nairobi Securities Exchange is the largest security exchange in our region, with a market cap of about $13 billion. It is a public traded market where the public is allowed to trade, unlike the private traded market, which is an over-the-counter market. So, like for example, if you wanted to buy shares for Family Bank, you will not find them listed on the Securities Exchange. Instead, you'll go to Family Bank, you'll approach them, you'll tell them, hey, I want to buy shares for this bank, and there is an unquoted securities market that is run by the Nairobi Securities Exchange. So those are the people who you would ideally approach. So if a client was to come to you and ask you, how do I buy shares that are not quoted on the Securities Exchange, but I know people have them, like for example, for Family Bank, you'd simply tell them, okay, just go to the Securities Exchange and they'll facilitate the same for you. So the securities exchange deals in two markets, debt and equity. So debt is simply bonds, but this is a secondary market. They also deal in.
Sorry, Charles.
Yes.
Just a reminder to be conscious of the time. It's approaching.
Yes. I'm trying to move as fast as I
proceed
can.
with the presentation.
Yeah.
Thank you.
Thank you. So now we have a debt market, and we have the debt market, and we have the equities market. So the equities market is primarily the secondary market for bonds. So these are not newly issued bonds. These are secondary bonds, means that they were issued before, and of course the shares. So quickly, bonds they're represented in two ways. There's price and there's yield. There are terms like clean price and dirty price. So clean price is what you see, but dirty price is what you pay. So a client may ask you, for example, nilienda kununua bond and I was given a different price than appears. You simply explain to them that they have to pay the accrued interest, which means they have to pay the interest that is has accrued since the last payment, because bonds are normally paid twice a year. So in this market, then how then as a lawyer do you come in? So according to the exchange, the first way you can come in is by being an investor yourself, so that you can understand the financial products that are offered by the exchange, how they are traded, how they move, what's going on where, so that because ideally you are the first point of contact with the public. The other way is mostly advisory, as my colleagues have spoken about. So this is anything from compliance audit to creation of the compliance documents themselves. There's the financial issues that may come about between all these intermediaries. These are disputes, of course. You can also come in there. Um, Transactions such as mergers and acquisitions and the block trades that we were talking about, those ones you can advise on them as well. You can also do legal opinions on each and any one of those transactions, legal audit, which you have mentioned. And also you can come up with, you can help in policy assessment and formulation, just like the gap that they identified with the circles. That would be uh, very well. So the next market is the treasury bond market. So unfortunately, we don't have a single treasury bond market in East Africa. So, but it might happen that your client may come approach you and ask you, then how do I trade in bonds? Because everybody these days wants to trade in bonds. Uh, so ideally, they will approach the central bank, open up an account with the CBSC. Foreigners, unfortunately, when it comes to the central bank, you cannot, at least in the Kenyan central bank, you cannot participate if you do not have a local bank account. So ideally, I guess the local bank account will be the receipt for the KYC in that matter. So again, we go back to settlement. So once you bid using your account and settlement is successful, the central bank will debit the amount in the registered bank account. So when you do set up this account, you're required to set up a bank account where you'll be receiving your biannual interest. So there are two types of bids. There's the competitive bids, then there's the non-competitive bids. That simply means that when you want when they offer a bond and you issue a competitive bid, you're saying that you'd like to have the bond at a certain price, because remember, bonds are issued represented as price or yield. So there's then also the non-competitive bond bids, where basically you're saying that whatever bond has been issued, I'm willing to take it as at face value. Okay, so lawyers can come in again with the bonds on the bit of succession. So this one is from personal experience. So a client comes and says that my father, mother, whoever owned bonds. So then, succession is over. How then do I proceed? So if you receive instructions of that nature, yours is to approach the central bank and engage them on the same. have the requisite documents from court, and they should be able to verify on their end, and the administrator then will therefore be transferred the bonds and any benefits that accrue to those bonds. CBK bonds can also be used as collateral. These are other transactions again. So you can be approached by a client that I have a bond. Is it possible to get a loan on it? Yes, it is. Same process as happens with the CDSC. There's a pledging of the bonds, where these bonds can be used to get you a loan. They'll value the bond between 60 to 90% of what the bond is worth, and then they'll do their own internal calculations, and then therefore they will be able to get you a loan facility. And in the meantime, they'll place a lien on the bond, so you cannot be able to transfer the bond in the intervening period. Okay, so crypto markets. So crypto markets also are markets that that we have in East Africa. So far, we don't have a collective market for them, but we do have a market for them. It's a growing sector. We are seeing banks recently in Kenya asking whether they can be allowed to manage and crypto assets for their clients. So the cryptocurrency market remains largely over the counter, mainly private players. But it's good to mention this. So Kenya introduced a digital asset tax of about 3% of the gross value of the transaction. Tanzania have also done the same, but they've used a 3% withholding tax to be paid by non-residents and into residents. Uganda and Rwanda have proposed to tax their assets, while Burundi doesn't have any clear regulations on the same. So then we have the futures market. So the futures market is run from the NSC Next. So we have two types of futures. We have single stock futures and equity index futures. So futures, basically what happens is that you want to trade on an underlying asset without actually owning it yourself, but you want to predict the value of the future. You want to predict the price of this asset in the future, and also you want to possibly hedge. So simply speaking, lawyers can advise on dispute resolution when it comes to futures, because futures are priced mark to market, which means that they are priced on the daily movement of the underlying asset. So if it's the equity index, like for example, the Next uses the NSE 25 index, then you can advise. Like I can give something from maybe about a bit of personal experience. So one of my clients deals in futures. So they were trading a single stock future. So the futures market only deals the futures are only for the very well capitalized stocks that we have in the country. So they were doing a trade, and the investment bank was also doing a similar trade, and that they should have filled their order at a certain price, which they did not. So then came up a dispute as to what do we do there, because there's some sort of conflict of interest. So by understanding the futures market, because this is a new market that people are playing in, and they might a client may come to you and ask you, then how do we go about it? But we were able to quickly and amicably resolve that question, and the respective investment bank made my client whole. So in closing, I would like to thank a few people who helped coming up with my presentation. So Liz Pandungu from the Nairobi Coffee Exchange, Steve from the CDSC, Steve Atema, Jackson Kimenje from the Nairobi Securities Exchange, and Mr. Sam Karima from the Tea Brokers East Africa Association, and Mr. Churchill Ogutu from IC Group. They were very instrumental in sharing as much information as they could, because if we are saying that we are going to be practitioners in these capital markets, we need to understand what they are so that we are able to plug into them. You'll notice that the transactions are quite lengthy, and there are so many areas, especially on dispute, because Of course, we can front end and say we can create rules and regulations and compliance documents and help them do compliance audits. These are our clients. But also at the end of the spectrum are the various disputes that do come up. Thank you.
Can you hear me?
Yes.
Okay, thank you. Thank you very much. Thanks, Charles. Thanks to all our panelists for the time they have taken to be with us this afternoon and for the insightful presentations that we have received. I don't know if there's anybody with a burning question. They can just drop it on the Q&A to be quickly responded to. But all in all, I would like all of you to join me in expressing our gratitude to the panelists and to the ELS Capital Markets Committee, as well as the Secretariat, led by Gabriel, who is here with us, and our able CEO. We are thankful for the time you have taken to arrange this for us, and I can confirm that it was very insightful from my point of view. Thank you, everybody, and we look forward to engaging in a similar event in the future. Thanks all. Anyone else wants to give a parting shot? Gabriel, go ahead.
Yeah, thank you so much, Ellie. Very special thanks to our esteemed panelists. Charles, that was incredible. Thank you so much. Doris, Patricia, thank you so much. It was really, really incredible. And to Adela and Alison, who had to drop off a little earlier, thank you, thank you, thank you. On behalf of the ELS Secretariat, we are grateful for your time and effort that you put towards preparing for this. I know many of you, our esteemed panelists, do enormous research. Sometimes you get to travel just to get some of the information that you relay to us. So we are really grateful. And the only justice that we can do for you, our esteemed panelists, is by learning and putting what you have taught us today into action. So we are really grateful and extremely excited that you've shared this information with us. We look forward to even having a more comprehensive or physical today convening where we'll only discuss capital markets. And hopefully we'll plan that ostensibly as the year progresses or early into next year. But on behalf of the Secretariat, our CEO, we are grateful to you for this wonderful session, and to you, our participants who have stayed on for more than 2 hours, just listening to the insights and wisdom that's been shared by our esteemed panelists. We're really grateful. It's because of you that we continue to exist. So thank you so much for your constant support, and your presence always gives us energy. So at this juncture, I would like to declare this session closed. I wish you all a very lovely week ahead and a very lovely weekend ahead of you. Stay safe and be blessed until we meet next week. So goodbye, and we can now exit at leisure. Thank you.
Thank you, Gabriel.
Thank you, Gabriel. Thank you, everybody. Goodbye.
Thank you. Thanks.
Bye.
Bye.
Thanks, everyone.